The subject matter here is the break-even rate. The break-even rate is essentially your ultimate survivability metric for firm performance. So essentially, if your firm is not performing up to the break-even rate, you are losing money. If you're performing beyond the break-even rate, you're earning money, which is quite good. So this is kind of the quintessential successful benchmark for any architecture firm. It also helps set your projections and expectations and performance analysis throughout your firm's management. But specifically here, we're going to talk about the break-even rate. So why this matters. Here at PrepARE, we focus a lot on both the ARE and practice. The break-even rate isn't just a formula that you need to know to answer a couple questions right on the ARE. It's about a few things that relate to firm performance and the rest of your career. Essentially, it is a financial management metric that is a part of the ARE, but it's also financial management for all firms. It is a high frequency financial concept, meaning that regardless of which direction you go in your profession, you're going to encounter this one. You might not spend a lot of time going through your profit and loss statement specifically, but knowing what your break-even rate for even a small firm like myself, I'm a corporation, but I'm essentially a single person that could operate as a sole proprietor, but it's important to know what I need to make the money I need to survive. So it is that foundation of firm survival. It's absolutely fundamental for firms of all sizes and scales. And it is definitely a key concept that is highlighted in the Architect's Handbook of Professional Practice. And I do have some commentary on that throughout this presentation, so pay attention because that is the key resource for the practice management exam. So it's really important as we go through this to understand the probably the place that break-even rate has in practice. And when you understand that conceptually, it becomes a lot easier to put all these key financial terms that you're going to learn specifically for the ARE into like a sentence or phrase that kind of flows and makes sense. It has a frequency that you can fully understand. So we're going to talk about some of those right now as background. So the Architect's Handbook of Professional Practice goes through a large list of very not necessarily specialized, but probably uncommonly encountered financial terms that we in the architecture profession, especially young emerging professionals, um, who aren't really in a practice management role specifically, don't often encounter. So that includes things like net operating revenue. You know, if you're a young designer, you know, architect level 1 or 2, or sorry, a unlicensed architectural staff level 1 or 2, or even a project manager that doesn't do a lot of actual firm management, net operating revenue might not be something you encounter. Direct labor. This is something that you know when you're spending probably 85% of your time on project work, you're probably not encountering direct labor very often. Indirect expenses and indirect labor. These are all things that if you're not in the, you know, quote unquote C-suite, talking about, you know, the how much your firm is spending on rent, how many licenses you need that year. That's all kind of uh, oh, there's no slides showing. Sorry. I thought I had it set to auto share. My apologies. There were slides. There we go. All right, let's go back. Um, Give me a thumbs up or a message if you can see the slides now.
Looks good.
All right, thank you. Um, Sorry, apologies. Let's go back and kind of just reframe this. All right. And do let me know if there's too much background noise. We have landscapers outside. Um, So, like I said, we're gonna begin by talking about the break-even rate. This is that absolute middle ground. Sorry, this is the absolute kind of survival metric that you need to know in order to understand if you're going to survive as a firm or professional, or if you're going to make profit. So it's kind of the key financial performance metric. Back to why this matters. These are the concepts. It has a very financial management focus, being at the center of everything financial. It's high frequency as well. So while there may be some other financial concepts that you don't really see too often, this one comes up quite a bit. And if you're ever going to, either moonlight or go out on your own and sole proprietor your way into the profession, you need to know this metric. It is your foundation of survival. It's the line between losing money and making money. And in terms of key concepts, this is probably the most key concept that's highlighted in the Architect's Handbook of Professional Practice related to firm health and financial management. So it's really important to understand what place the break-even rate has throughout the kind of like flow of all things that are financial management in architecture firms. Moving on to the financial framework, sorry, pardon me one second. Some of the concepts that we're going to encounter are some of sorry, resetting kind of threw me off. All right. So we're going to deal with a lot of terminology and concepts that in some ways are going to be less commonly referenced, but they all relate to the break-even rate. They either feed into it from the back end and affect the break-even rate, or what the break-even rate does related to the information that's fed into it may on the other end affect other financial terms or financial metrics. Key performance indicators go through that. Net operating revenue being one of them. Of course, now they do landscaping like this. Okay. Direct labor is another concept that we're going to talk about. We're going to talk about indirect expenses and indirect labor. This is every expense that your firm has that either is going to be put on an overhead side or a direct labor side, and this all feeds into your break-even rate. So there's your overhead rate. We're going to talk about that break-even rate, and we're going to discuss net multiplier. These are not all of the terms that you see in the Architect's Handbook of Professional Practice, but these are the ones that probably most directly either affect or are affected by the break-even rate. Get into that in just a moment. First, before we get into the break-even rate, let's talk about the overhead rate. In order to get your break-even rate, you need to understand essentially two things. You need to understand, in technical terms, you need to understand your indirect expenses and your direct labor. So let me simplify that for you by saying this is essentially anything that you do to perform the work of a project. Let's say you get a contract, $100,000. You need to do that work to earn $100,000. Let's wait 1 minute for that. Just a moment, I'm going to close that. Okay, and I'm back. Anybody who has ever worked with me knows that anytime I take a call or have a presentation to do, that's when they do landscaping right outside. Okay, so the overhead rate. The overhead rate is essentially a component that feeds into the break-even rate that is telling you what happens outside of the earnings of that particular project. So that means anything from like software expenses to rent, and that's your total indirect expenses. And that's going to be a ratio to your total direct labor. That formula looks like this. The overhead rate is your total indirect expenses divided by your total direct labor. Um, this this is essentially going to tell you it gets you to a multiplier that gets you to a performance metric that defines your profitability. Just a moment. I did just want to take a moment because I noticed we have a few people that jumped into the presentation recently. Um, I made a comment before we got started that if you have questions before you had jumped in, that if you have any questions, we would like this to be conversational. So feel free to jump in, open up your microphone, ask questions about anything along the way. Feel free to interrupt me. I don't call it rude. I call it great conversation. So you could do it in the chat. I have the chat right next to what I'm presenting, and or you could just open up your microphone and ask me a question at any time, or if you have a comment, go ahead. Okay. Thank you, Diego. Uh, all right, so back to indirect expenses. Indirect expenses consist of essentially um, anything that's not directly attributable to your project expense or services. So that's going to be like your rent, your administrative staff salaries, firm insurances, your marketing and advertising costs, any non-billable time if you're cleaning up the office or doing like a move or something like that. That all goes to indirect expenses. It's down here. Sorry. So now let's talk about how that overhead rate relates to the break-even rate. Again, so you have overhead. If you're going to be in business, you have some expenses. You got to pay for your software licenses. If you do have an office, you pay for rent. But then you have to make enough money over that to actually make the profit that your firm needs and desires. So that's your break-even rate. That's what we're trying to figure out. That's your overhead rate plus what the Architect's Handbook of Professional Practice calls a unit cost of 1.0 for an hour of salary. And they couldn't have said this any more confusingly to somebody who's brand new to this concept, because essentially what this is saying is your overhead rate plus what you bill, or what you pay for that person, essentially. Sorry, not what you bill. So it's just the cost of the services plus the cost of anything that goes into supporting the services. That's it. Um, so really they're simplifying it. They're already starting to simplify that overhead rate into a multiplier for you. When you read something about this, think of it already as a multiplier. They're just taking $100,000 and dividing it, you know, down to a ratio, a multiplier value. So your break-even rate formula is to take those words and kind of put it in just a formula. That's going to be your break-even rate is your overhead rate plus 1.0. Again, that 1.0 is essentially just your services cost. So when we look at it in terms of that multiplier as it looks in term related to dollars, essentially what this is telling you is that for every $1 that you pay in salary, your firm must earn however much more. In this particular case, the break-even rate being 2.3 to break even. That means if your earnings, your revenues equate to a break even, or if your revenues equate to a multiplier um, across the whole firm to 2.31, you've earned some money in profit. If it is 2.29, you've lost a little bit of money in profit. And let's look at it in a couple of different ways here. So that visual breakdown is essentially for these are the three components that go into your firm performance. At the very, very base level, this is everything you need to know. Your salary covered, your overhead covered, and your profit. Um, so for every $1 in this example, if you're paying your entire firm $1, you essentially have $1.30 in overhead costs. You need to charge $2.30 for an hour of time. And so your profit is $0. So you've survived, but you haven't put any money in the bank over, of course, the salaries. Um, so let's talk about that survival threshold. This is really where the analysis of not only the architect registration exam, but also just thinking about your firm's moves really come into play. The survival threshold is what this is for. So contextualizing this and internalizing it in terms of how you analyze what firm financials are is going to help you put these financial terms in a place that makes sense to the whole fabric of the system. So essentially, if your billing rate is the same as your break-even rate, your firm is going to survive. You're going to earn the money that you've set out to earn to pay all of your salaries, including if you're the firm, if you're the owner of the firm, including your own. Um, the billing rate, if it's less than the break even, sorry, if your billing rate is less than your break even, the firm is going to lose money. That means that essentially, if you have a multi-person firm, um, you may pay all of your employees, but then the person who owns the firm is actually losing money. So that comes out of their salary, essentially. Um, and then if the billing rate is greater than the break even, then the firm profits. Of course, the thing I said about salary depends on how you set up your firm structure, but that's a conversation for another day. Let's go on to some more. All of this is getting to a point of understanding the net multiplier. The net multiplier is essentially what most firms use to identify what they bill. So if I pay someone $25 an hour and I have a multiplier of 2.0, I need to charge $50 for that person. Um, that net multiplier is the ratio of your operating revenue to your total direct labor. That relationship looks like this. Your break-even rate is your minimum net multiplier required to cover all costs. So your break-even rate is a multiplier. It's a benchmark of a multiplier. Profitability then is achieved when the net multiplier exceeds that break-even rate. So this is really your most crucial successful benchmark for architecture financial performance. So let's talk about that then. Just to give you another visual of this, this is probably the most important thing to understand is the impact of what that multiplier and break-even benchmark is saying. So essentially your break-even point, if it's a 2.3, you're good. If your multiplier for what you're billing is 2.3, then you're not making any profit. If your multiplier is 2.6, you're making some profit. And if your multiplier is 2, you're losing. You're losing money. So this is kind of just your basic understanding of what that break even is relative to a multiplier analysis. Let's get into it in practice. Before we do that, though, just wanted to take a quick break and see if anybody has any questions about what I've discussed so far.
So is the word rate in this context less about like a rate of something happening over time and more about a billing rate, like a cost?
Um, yeah, actually, now that you mention it, I don't love the word rate for that. Um, but yeah, it's essentially saying like it's a multiplier that sets your rate, if that makes any sense. So I guess they're interchangeable, but it should really be a break-even multiplier.
Can you give us an example?
Uh, um, sorry, I would I need some clarification on the context of what do you mean by an example for that one?
What you're talking about, excuse me, you're talking about rate, and Ari had asked, what does it actually mean? But I work better with examples, I guess. That's just
Well, so think of it this way, right? Like when they talk about billing, right? So all right. Mm, Your key performance indicators, when I say that, I wish I had a diagram for this, but if your break-even rate is like your center line of success or not success, um, it really is in the multiplier piece, but the multipliers go either way. So information from how many expenses you've accrued, your overhead costs. Let's say you pay $100,000 in salary and you have $150,000 in overhead. That essentially means that you have a 1.5 overhead rate ratio, essentially, that feeds into it. And that is plus your 1.0, 100,000 and 150,000, for instance. So add those values together, you get a 2.5 break even rate slash multiplier. Um, so when it says rate, it's not necessarily like a rate until you assign it to a dollar value. And I do have an example later on in the presentation where maybe that'll make more sense.
That makes sense. Thank you.
Okay. Okay, well, let's get into practice because actually, this is where it starts to get real and it starts to look like a rate. Um, where am I here? Okay. So yeah, there are a series of decisions that we'll be making in firm management, financial management. One of the things that we have to balance when we look at are we profitable or not. So now we're kind of on the other end of that break even rate. We know what we need to make. We know what we're billing and we need to analyze what adjustments we need to make. Do we need to look at are we hiring too many administrative employees? Are we hiring too many project employees and not enough administrative employees? How well are like do we have so many employees that they're not being utilized enough that we're able to realize another financial term to realize the full value of the employees we have. So the break even rate. Oh, sorry, we have a question there. All right, how's the multiplier factor used by a firm? Okay, sorry, I should probably discuss that before we go back to this. All right. Um, well, actually, I think we're kind of talking about that now. So I'm just going to pop these up and we'll talk about all those. Priyanka asked, how's the multiplier factor used by a firm? Um, so as we get into it, it's um, knowing the break even is essentially just knowing your bare minimum. That's saying I need to make this to make all of my salaries and pay all of my expenses and not have to, use credit or lose working capital or something like that. Now, when it gets into strategy, you start thinking about things like this. You start thinking about whether or not you have the right staffing. Do you have too many or too little? Do you need to think about what software you're using and changing your overhead value to get it back into a place where it needs to be. Every decision that we make really does have an effect that flows through this break-even rate. Um, a good example, I have some example questions later on, but one of them says, for instance, your firm is considering moving to a, new location where the rent is 40 time or 40% more than its current location. What impact does that have on your break-even rate? And so that essentially will increase your overhead, which means your break-even rate is going to go up. Does that help, Priyanka?
Yes, thank you.
Okay, great. So let's kind of try to tie this both into firm strategy and then ARE strategy. This is so that we can understand when I say contextualize this and internalize this, I want you to truly feel in your mind and heart when you see these words where they are and kind of visualize them happening through the firm like that. So that was a great question. Thank you. Um, so some of the things that the area you're going to test are essentially identifying the right step of it's not the formula. I would like for you to think of like overhead rate, break even rate, profit, percentage and things like this as kind of sentences in a paragraph because it's not a formula. You don't need to learn break even rate and you're good. They all feed into each other. It's essentially a hierarchy of formulas. So the ARE will test you in a few different ways in a few different contexts about how these formulas are affecting each other and ultimately the performance of your architecture firm. You'll need to interpret certain financial scenarios. So you'll be given information about the firm's financial situation, and you'll be tasked with analyzing and coming up with a solution to or response to a condition that you see in the numbers. Um, Net multiplier values against the break-even rate. Like I said, they're kind of essentially the same thing. You just need to know that your net multiplier is the multiplier that you apply to your billing rates. While the break-even rate is just a static number, you need to be above. Pardon me. You'll need to understand the distinction between direct and indirect costs too. This is probably the stickiest part about the newer emerging professional who doesn't have a lot of experience in firm management to truly understand. And it comes down to um, staffing. Um, which staffing working on which parts of a project is considered direct or indirect? Because it's pretty clear that software cost is indirect. It's pretty clear that firm insurance is indirect. But what about the workers' comp insurance? Where does that go? So that one we're going to talk about a little bit later on, but essentially um, anything that goes into salaries and benefits, anything that goes directly to employees. Um, that is your direct costs. And then anything that doesn't go directly to the employee is an indirect cost. And that's like the best way to delineate the two. So for instance, workman's comp insurance is indirect because that money doesn't go to the person you're paying, it goes to the government. Same with payroll taxes. Those payroll, when you pay an employee, you have payroll taxes, you pay a portion of their payroll taxes that goes to the government. That's indirect. Now, one thing I want to point out about this slide is that a lot of, especially people who are just starting the ARE journey and haven't taken like a standardized test in a while, they may have some trauma from their school days about traps. Some exam creators may have in the past tried to sort of trick you into the wrong answer. That is not the ARE. They don't build in traps. So when I say common ARE traps to avoid, these are more like logic traps in your head about how to look at the content and how to understand what you're being presented. So one of the things to be careful of is confusing revenue with profit. Um, if you spend more time with financial management terminology and key performance indicators, you'll begin to understand more intuitively the differences between the sort of stages of analysis. So there's like the investment, what we pay our people. There's what we charge for our services. There's what we pay to support all of the firm. Those are all the things we were talking about throughout this presentation. But understanding that revenue is simply just what your firm earns from doing the work versus what you've earned after you pay for everything is your profit. You could visualize it as just, what the firm essentially like receives and gives out, and then there's receives and then puts into the bank for something else, whether it's investment or future profit sharing or distributions for shareholders and so on and so forth. It's important, like I said during the last slide, don't to really learn how to not misclassify indirect labor and expenses. So you'll read through it once and you'll probably get 70% of it right off the bat. That's definitely indirect, and That one's definitely direct. But spend a little bit of time preparing for the ARE, just trying to understand which ones are a little stickier. And then forgetting the break-even rate. So the break-even rate you may confuse with your multiplier, but it's not. So like I said, the break-even rate is not something that changes often. It only changes when something changes in the structure of your firm. Break-even rate is just a line that you need to be above. Whereas your multiplier can change a lot. You can decide to change your profit target from this year at 15% to next year at 20%. Or if you change it to 20% for 1 year and not a single one of the project managers at your firm has met that metric, then maybe your firm's leadership will decide, maybe 20% is a bit too much to target, as a performance goal. Let's move it back down to 15. And that will change your multiplier. That may clarify a question for you, Priyanka, as well. But that does not change your break-even rate. So here's some fast logic. One of the things I like to do when I'm kind of contextualizing these concepts from practice into ARE is just look at it in terms of just a logical framework. Anytime you encounter something that has to do with par particularly finances, the analysis goes in this direction. This is the order in which you're most likely going to encounter either having to find information that feeds into something or how to take information and push it forward into a future analysis. So in almost all cases, you'll need to identify or find or calculate the direct labor costs. So this is your cost of employee time directly spent on a project. You'll also need your indirect expenses. That's the overhead piece. So that's anything not directly tied to a project. You'll need to calculate your overhead rate. So that is that indirect expense piece that's going to relate to your direct labor costs. And then you'll calculate that break-even rate. So the indirect expenses and direct labor costs just feed through that system of what's your overhead, what's your break-even. Now we need to think about something like profit. We're going to compare that to our net multiplier to understand whether or not we're profitable and if we're meeting the goals by the billable rates that we're choosing. So let's understand this one as essentially your break-even rate formula is your overhead rate plus that 1.0, it's your salary expenses. This is what you need to cover all operational costs, no profit just to survive. This is the key line. Like I said, if nothing changes in your firm, your break-even rate does not change. You can change your profit goal, but your break-even rate will stay the same unless something materially changes in the financials that support your firm. Profitability is defined by this break-even rate. So your firm leadership will be playing around with and meet over and discuss what does our staffing look like? How much admin do we have? Are we meeting our utilization, or what is our utilization, and are we meeting our realization goals? And even things like, are we using the right software? How often are we replacing our computers? And so these will have a minor impact that will change your break-even rate that ultimately affects your profitability. And then, of course, this is going to be your key business driver. It is the absolute minimum you need to survive, and just how do I say this? Just experientially, the amount of people that I've talked to, especially kind of striking out on your own for the first time, that hear, oh, well, my previous firm would charge, $150 for project technical staff, and so that's what I charge for when I'm working on project technical staff stuff. And that's not exactly the right way to do it. It may work for you, and it may actually benefit you to use numbers that a larger firm have used, but a larger firm is going to have a lot more overhead. So for instance, like I've worked at firms that have had an overhead rate of 1.4 to I think a 1.8, if I'm not mistaken. Um, but anyway, that gets added to the 1.0, so they're in the range of like a 2.5 to 3.0 break multiplier value, or sorry, break even rate. Um, and mine, since I work at home in my garage, I have very little in terms of technical needs. I don't have an IT department. My break even rate or my overhead rate is a 0.32 or something like that. 4.3. Um, so my overall break even rate is, I think, a 1.4, where most firms are above 2. So just kind of giving you an understanding of how that works from scaling from large firms to small firms. So I want to pause and I want to talk about that profit piece, but that's essentially the explanation of break even. Do you have any questions before I jump into a commentary on profit? All right. Hearing none. This is really, really important. It's a little bonus section I want to add on here because we've talked about profit, and profit is one of the most frequently misunderstood calculations in all of business. And if you read the Architect's Handbook of Professional Practice, like I do, you'll look through the tables and you'll reverse engineer them and you'll try to recalculate them, and you'll see the unless you've experienced this before, which I'm not a math whiz and I didn't. You'll find that if you try to reverse engineer it and you try to look at profit as a value of, oh, I need to pay somebody $50, I want to earn 20% profit. So $50 times zero point 0.2 is $10. So I need to charge $60 to earn 10% profit, or 20% profit. That's not the right way to do it, and I'll explain why. Um, Whoops, that is not supposed to have noise. Sorry, that's not supposed to have noise. I don't know if you guys heard that, but anyway, we'll just jump to this. So this is an example of a kind of a staffing expense calculation for like a junior employee. Let's say your firm's profit goal is 25%. The person makes $35 an hour. There's a 150% payroll burden overhead essentially. So that's a subtotal of 87.50 that we have to pay for that employee to be earning their $35 an hour. If we want to earn a 25% profit over top of that, we have to use this calculation, 87.50 divided by 0.75. And I'll explain why in this next diagram. There's the wrong way essentially takes 8750 and it multiplies it by 0.25 to get a value of 21.86, and it adds that back to 8750 to get a value of 109.38. I'll explain these diagrams in a moment, but the correct way is to do 8750 divided by 0.75. So you're dividing it by the inverse of the profit goal that you wish to achieve. It gives you a value of 116.66. Now, why are those two values different? Does anybody have a response for that? All right, well, I'll jump into it. So essentially what we're looking at here is, in the diagrams below is, let's say we do the 8750, that's this orange block. We multiply it by 0.25, that's this tan block. And we add another value of that, right? When we take the 109.38 and we essentially consider the 8750 plus the 25, if we take, sorry, 20, excuse me, pardon me, 8750 is this full orange block. The 0.25 that we've added onto the end of it is this blue block. If we take the full value, 8750, which is this whole orange block, that's actually at the end of it, when the value is 109.38, that accounts for 79% of the overall value. So that means we really only earned 21% profit because the profit is everything above the value that you're calculating for. So essentially, if we divide it by the inverse, that 25% is a part of what's added to the end plus the additional extra, which means that the resultant value, 8750, is and remains 75% of 116.66. So the billable value over that 8750 is 25%. Thank you. All right. So that is a very, very, very important thing for you guys to understand. And that's kind of my bonus lesson on top of the break-even rate. So I've pretty much reached the end of the content for break-even rate plus this little bonus section of profit. I do have some example questions if you do want to have kind of an open forum of talking through some of these, but I'd first like to spend perhaps the remainder of the 8 minutes on our session here to just open it up to general questions and content about the presentation.
One thing that came to mind as you were talking about this was how these rates might be used by, like you mentioned, the sole proprietor who maybe is not operating with quite the same mindset, let alone the same, structures as a larger corporation.
That's a very good question. Yeah. So, and being effectively a sole proprietor myself, I do deal with this. It was one of the hardest things getting into business for myself that I didn't I didn't know like what do I need to work for every month? If I'm just working, for to earn as much money as possible, what does that mean? When can I relax? When do I get to go to the pool? Um, so I mean, um, the way I'm trying to think of like where the transition point is. The way it rolled out for me is that what it does is it allows me to understand if I quantify all the things that I have in my life that are part of business, I can calculate those in a document essentially that gives me a value that pumps out what I need to earn annually. So I actually have a spreadsheet that shows my mortgage, and a portion of that goes to my office, which is in my garage. I calculate my computer, how roughly much I spend on hardware every so many years. Add all of that up, and that information becomes my overhead. So my overhead rate's very small because I am a sole proprietor. But it is important. Diego just asked how much for the spreadsheet. I'm happy to send it to you. Send me an email. I'll put my email in the chat. Um, but the um, the important piece about it, I think, is that it's really difficult for someone who's a sole proprietor, not having a formal business structure and having mixed financials, because you're operating out of your own bank account to really separate and quantify what goes into your business. If your computer is used for work and for, home play, whatever, what what portion of that value do you add? And it becomes quite complex. But really, it's a worthwhile exercise to sit down and really estimate how much you can. Have you ever heard of the cost estimation principle?
No.
It's another thing I cover in some of my classes. Hang on one second. Well, actually, I'll just draw something for you. All right. So the cost estimation principle is essentially this. You have something that you need to estimate how much it costs. And this, for project work, it's like, how do I create a bid, right? Like how much is this building going to cost? overhead, whatever. So this could represent how much it costs to build a building, or how much it costs to estimate, and or how much it costs for me to run my firm as a sole proprietor. Effectively speaking, as we guess this circle, we can guess, I don't know, $15,000, right? Like $15,000 a year is how much I have over it. I don't know. But if I guesstimate a little bit more accurately, I can break this down and start looking at just a quadrant. What percentage of this box do you think is covered by the circle? It's above 50, maybe below 75. So we get a little bit more accurate on that quadrant. Then we break it down once more. Now this one we know is above 75, but possibly below 90. And we keep doing that till we get to a point of accuracy that we're reasonably happy with, because now we know 100% of this box. We know 100% of this box. No, 100% of this box. And we know most of these other boxes. But the point here is, like, if you're a sole proprietor and you want to get into business and you want to be serious about how much you need to bill, your best advantage over other big firms is to truly understand how much you're spending and how much you need to overcome your overhead plus what you need for your profit. Um, to get to a point, because we're the ones, people who are working alone, small firms, one person, two people, three people, maybe, they can charge much lower rates. They to and possibly even more than they need to earn a higher profit percentage because they are smaller. So it's a worthwhile exercise to get down into the details of how much do I spend on my computer? What percentage of my home computer setup is spent on work? 60%, 70%? Put a guess in and calculate it and get to a value that seems reasonable. And it's worthwhile for that. Did that an is I feel like that at least partially answered your question, but I don't think it answered the whole thing.
I don't know that it's possible to answer the whole thing, but the conversation is what I'm interested in, so I appreciate it.
Yeah, yeah, yeah. I'm trying to, I mean, I could talk all day about my experiences on it and how long it took me to actually take this seriously. Um, but once I did, it gave me a number that I work for every week. And now, like I can project out 2 or 3 months, and look at, do I have enough project work in the pipeline, even though I'm just myself, to survive the next, 3 to 6 months. And before that, I would just run dry on projects because I was so project focused. I'd go, 1, 2, sometimes 3 months just without work because I wasn't looking ahead. So these KPIs and metrics are really important. Any other questions? Conversations?
We don't have
All
time
right.
to walk through that example problem, do we?
Yeah, we can real quick. I got a bunch actually. Let's see here. Hang on, why isn't that going full screen? Um, yeah, I'm happy to hang on for a while. So let's talk about these. Another thing, let's go like ARE. ARE, I'm going to try to keep this rather concise for you too, so you can really kind of like crunch it and think about it. But each topic you learn as you're preparing for the ARE, it's very helpful for you to think about and try to relate to the many ways that that topic might be encountered in a testing environment. So in this case, I have like, I don't know, 9 or 10 questions that are different styles of question that all relate to break-even rates. They all look at them differently. So I'm going to go kind of quick and through at least a few of them, and then you can we can dive back into some. But like a good example is like whether or not you have a visual aid like a table or something like that. An architecture firm reports the following annual data: direct labor 400,000, indirect labor 150,000, all their indirect expenses $250,000. What is the firm's break-even rate? Um, the firm's break-even rate is essentially 2.0 because it'd be the 2.0 would be the what was that one? Oh, yeah, yeah. So it'd be the 2.0 because it's the indirect expenses plus your indirect labor, right? So anything that's indirect plus your direct labor. So that's 400,000 plus 400,000 is essentially two, or 400,000 divided by 400,000 gives you a one plus your one for the value there. Um, but anyway, the calculation is not the important piece of this. I want you to understand that like you're going to be provided these values, and you're going to have to calculate for what is the break-even rate. You may look at it slightly different, a numerical calculation. So you've got $100,000 direct labor, 120 and 30. You have to add the 120 and 30, gives you the 150. But this one's going to be 150 divided by 100,000 gives you the 1.5. And then you're going to add that to the 1.0. You may have multipliers and break-even considerations together. This one says a firm has a break-even rate of 2.4 and a net multiplier of 2.2. Based on this condition, what is the firm's financial position? And so some of the slides you saw earlier show essentially just, are we profitable or not? And in this case, we are not profitable because our multiplier is below what we need for our break-even rate. You may look at a profitability diagnosis type of question, and it could not have any new numbers at all. So, firm with a strong project backlog is reporting losses. The staff spends significant times in meetings, trainings, internal coordination. What is the most likely cause? The most likely cause is going to be your indirect labor increasing your overhead. It's because your team is not spending enough time on direct project work. And so here we've got cost classification. So which of the following costs should be classified as indirect expenses? We talked about that earlier. Just knowing which ones are or are not. So anything that's specific to a project is going to be direct. Anything that's indirect is going to be not specific to a project. In this case, that's employer paid payroll taxes and marketing staff salaries. You could have a what happens if situation. So I mentioned this earlier about if a firm signs a lease for a larger office, increasing rent by 40% without increasing staff, what is the most direct impact? The most direct impact, of course, is going to be your break-even rate's going to increase, like I said. In fact, in this question, this is one that trips up some people too, because it says what is the most direct impact? Your break-even rate's going to increase first. Your net multiplier might increase and theoretically should increase if you still want to make the same profit target. But it is not necessarily going to increase, and it is not a direct impact. The only one that absolutely happens is your break-even rate will increase here. You may look at fee and billing rate alignment. So if a firm has a break-even rate of 2.3, they have an employee earning $50 an hour, but they're billed out at $100 an hour. What is the firm's position on this labor? Are they making a profit? Are they breaking even? Are they losing money? Or is the overhead decreasing? In this case, you have $50 an hour billed out at $100 an hour, which is a multiplier of 2.0, which is below your break-even rate. So we're losing money on this employee. I think there's only like two more left, so let's go through them. You may have to solve backwards too. especially for numerical analysis, you guys can always encounter a question that's going to ask you to do it forward or backward. A firm with an overhead rate of 1.4 wants a net multiplier of 2.8. What level of performance above break even is required? So essentially, they're looking for a 0.4 performance above their break even rate because you're going to add your overhead rate to your salary rate, which is always going to be a 1.0. And then you may have management decisions and analysis. This question example is a firm is considering hiring additional administrative staff to improve operations. No increase in project workload is expected. What's the most likely financial outcome? This is, again, administrative staff, but the project workload stays the same. So our overhead will increase and profitability is going to decrease, unless, of course, we change our multiplier. I think that's about it. But did that give you a good sort of well-rounded look at the many ways and angles that the ARE may take? Diego asked, where can we get more questions for practice? Yeah, great question. PrepARE has practice exams, many of which are free and available to anyone that wishes to jump in and do some of our freely available ones. We do have a paid version that has full practice exam lengths, over 100 questions per section. But of course, we are in the business of helping you pass these exams, and so we're not exclusive to pushing you guys our direction. So I thank you. I was going to go there. Which one did I use? Or rather, which one would I suggest? I took the ARE 4.0, 4.1 or something like that. And I used a combination of available questions that people had put online for that exam, plus I think it was the Ballast books or Kaplan books. The way I did practice exams is I tried to do section by section practice questions. Sorry, pardon me. I'm a little under the weather today. I tried to do section by section practice questions to understand, do I have an expertise on this particular thing? Or not an expertise, but like, do I know this thing or do I not know this thing? So it was much more available back then to quiz that way. Nowadays, people are mostly focusing on creating full breadth practice exams. In which case it really depends on if you're gonna ask me like which one I would suggest for you, it depends on what you need. Um, the questions that like walking the ARE have are incredibly difficult questions. They're meant to challenge you to get to a point of expertise and mastery that you will never need to you'll never encounter really I guess like a gap in your memory for that one. They're very difficult. I think I haven't really perused what else is out there. Designer Hacks has a set. Um, Everybody that's creating content now has some. I know Elif Byram, I think is how you pronounce her last name. She's fantastic. Loves helping people, and she does coaching too. But her questions are lauded as some of the best on the market for specifically the ARE 5.0. Yeah, so you could always email us and we're happy to give you resources for what you need. Thanks. Priyanka, you asked which exam did I give first? Could you clarify that question for me? I'm gonna close this down and just go back to camera.
Just asking about what to attempt first, which practice management
Ah,
program analysis. Yeah.
okay. Pardon me a moment. I gotta just blow my nose. All right, sorry. Thanks. Um, yeah, so I have a few different ways of approaching that question, and the answer is not always the same, and a lot of it has to do with who you are and how you are planning to test and what your strategy is going to be. The um, So there are essentially three ways of doing it. You could do linear and just like start with practice management, go to construction and evaluation. You can do the packaged or grouped method, which is probably the most popularly suggested method, um, where you do practice management, project management, and construction and evaluation together. Study for them all together and just kind of take them in succession, or if you fail one, just take a different one. And then there's the PPD and PDD, but you could take PA with that. But PA also you could take separately. The what I would suggest for you is consider what experience you have, what practical experience you have, and think about what's going to be hardest for you to learn. One of the things I like about starting with practice management and project management is that particularly with practice management, is that it reads and feels a lot more like studying for an exam. Because for most emerging professionals, it's not knowledge we have, so it's new content. The content is relatively black and white. There's there's less judgment and kind of like best case options to trip you up on. So I generally point toward practice management first, especially if you haven't taken a test in a number of years. It'll get you back in the practice of testing. Um, but after that point, I think it's more important to think about how often are you going to be testing and which tests are going to be difficult for you. I would say if you have a period in your life where you if you have a period in your life where you're going to be more available for testing, I would say take the more difficult exams during that period. But if you're going back to grad school or if you're planning to get married or and you're going to be spending a lot of time, focused on other things, you save the ones that you think are going to be easier for you for those periods. Does that make sense?
Yes, thank you so much. I'm
Yeah,
just
I'm a
starting out. Yeah.
Yeah, yeah. I know like every time I respond to that question, I know it comes off a little bit like, yeah, you answered it, but you didn't answer it. And I know that's true. And I'm a strong proponent for I think you already know the answer to most questions that are around like the general strategy of ARE. It takes just a little bit of introspection to understand how would or could I do it? And then I think you could ask all the questions in the world, and I think you would still fall in a relatively tight arena of actually executing it that way.
Thank you. I understand.
Mhm. Any other questions?
No, thank you so much for the presentation.
All right, thanks, y'all. Hopefully the landscapers and me having. Oh wait, I do see a question from Diego. When did you realize you were ready for PCM, and how did you notice? That's a good question, Diego. So like I said, I took ARI 4.0, the previous version. So practice management wasn't specifically an exam on that one. But I'll give you a quick brief version of my ARI journey. I didn't study at all for the first test. I just needed to see it because I read articles, I looked at the textbooks, and I was like, I don't know how to tie this to the test. So I got it was called schematic design, I think was the exam. Um, I got like the schematic design test textbook, looked through it a little bit, and then went and took the test. I failed it. But at least now I knew what it looked like and how to study for it. So I went back and studied, and like 2 months later, passed it. And I don't I don't think that you ever really know. I'd say about half of the exams I took, I felt ready for, and half of them I didn't. And outside of that one fail, I didn't fail another one after that. There was one that I like um I didn't have a chance to study at all because I put them like 2 weeks apart, and I didn't study really at all for the building systems exam. And I thought I was so going to fail. But I passed. And I was like, okay, all right, that's awesome. And so on that front, the one bit of advice I have for you is actually I got two bits of advice, Diego. Schedule your exam and don't reschedule your exam. Um, as long as the $250 or whatever isn't going to put you out or adversely affect your livelihood, just do it. You know, keep doing it. Do it every 60 days. Just take and retake and whatever. If you know, you know, and if you feel ready, you feel ready, that's fine. Just do it. It's always going to help you. It's never going to hurt. Thanks for the claps. Sorry. Thanks for the claps, Diego. All right, thank you all. Well, you have my email in the chat there. You could always reach out to me or Mike if you have any questions, and hopefully we'll see you guys at more office hours.